Hello and welcome to your daily note for February the 11th, 2022. So we did get the CPI data. It did come in a little bit hotter than most were expecting, and we're going to dig into that as far as the initial jobless claims as well. Then we're going to move into market interpretations. Real quickly here, the CPI came in at 7.5%. Forecasts were for 7.3. And that 7.5, if you recall our video yesterday, that was closer to the top end of our forecast. We had one forecast that was closer to 7.8 and one that was closer to 7.57. So this ended up coming into the top end. The monthly increase was 0.6, the exact same as the core CPI, and then the core CPI came up to 6%. Initial jobless claims continued to decline, 223,000 persons versus the forecast of 230, and even versus the prior at 238. Today we're going to get the University of Michigan Consumer Sentiment Survey, which probably will highlight this drag of inflation on their incomes here. So let's flip over to the inflation report itself and talk a little bit about some of the things that I thought were interesting. Of course, over the last 12 months, all item index increased 7.5%. The largest increases came from food, electricity, and shelter. They're the largest contributors to this. Food rose 0.9% in January. Food alone was up 1%. Coming down a little bit further, the food at home index rose 7.4% over the last 12 months. All of the 6 major grocery store food groups increased over the period. It's by far the largest increase was for the meat, poultry, fish, and egg category, which was up 12.2% over the last year. And the index for dairy and related products increased 3.1%, which was the smallest increase among the groups. Food away from home also increased, but increased only 6.4%. So if you're thinking about the retail side or kind of the set-down restaurant style, these are pretty significant price increases that eventually are going to have to get passed on to customers, and unless you are absorbing those, which are certainly going to suppress your profit margin. So restaurants are going to certainly feel the brunt of this. Now, if we look at individual components of inflation, energy, of course, being a massive contributor here, up 27% year over year, primarily coming in 39%. 40% in the gasoline, 46.5% in the fuel, electricity and utilities up 10 and up 23. And then, of course, we're still also seeing the used and new car market, although softening a little bit, they're still up 12.2% and up 40.5% over the last 12 months. So if you have a used vehicle and you've been kicking around the idea of getting rid of it, now would certainly be the time, as we're starting to see that soften in January's report, where it may have peaked here in December's report. So the other key component that I saw really start to accelerate was shelter. Shelter coming up almost 4.5%, and it is coming up a little bit, 0.3%. But really, the increase is broad-based. If you're looking at January here, there's really only a couple categories that declined. So you got gasoline that came down a little bit, fuel oil that came down a little bit, and then here the utility piped gas services came down a little bit. So it's interesting to see just about everything across the board continue to accelerate. Now, what did that end up doing in the market itself? Well, it ended up causing a broad sell-off. I think a lot of people bought the dip and they expected the CPI report to continue to come down. Our estimates were even seeing that, but as I started to look at some of the key components of it, like WTI crude, gasoline, and even looked at some of the other Baltic Dry Index, things of that nature, we did see it slowing, but at the same time, I think the oil and the energy was kind of overshadowing it, and that's why I highlighted in our video that the top end could be possible. And so I think it caught people off guard. You combine that with the fact that Bullard came out right there mid-afternoon and said that he would be in favor of a 50 basis point hike in March and another 50 in the summertime, getting you to 1%. And so that really spooked the market, and then because it's a faster tapering process, and so then you got a repeat of the sell-off here. I am going to go down to the yield curve because I think that's where it primarily manifested. Your 2 year, I'm going to blow this up a little bit bigger so you can see it. Your 2 years now at 1.6. Your 10 year is now 2.03. That continues to narrow. Our estimate was for Q1 to be at 0.4. We're already there. We're already hitting that estimate very quickly. You almost have an inversion in the 10 year and the 7 year, 203 and 203. The 1 year spiking to 1.14. Your long end, the 20 and the 30 did jump up, but not near as high as I think the rest of the curve, as kind of the middle or the belly of the curve between the 1 year and the 10 year really started to sharply move higher. Something that I've included in here as well is, and I'll continue to post this. It just kind of shows you where the Fed is right now and what potentially they're going to have to do to play catch up. There's a lot going on in this chart. You have a blue line there that is this first. Let's actually flip over here. I think it'll be a little easier to see it on the actual Fed website versus on the web page there. So this first blue line here, this is the 2 year Treasury. You then also have an upper and a lower limit to the federal funds target. Then you have the effective federal funds in green, followed by the purple line being the 1 month Treasury Security. So the 1 month usually tracks the Federal Reserve's effective funds rate. It tracks it very, very well. In fact, it can lead it in some manners. Take, for instance, right here at the end of 2018, where we saw a break in the 1 month and in the 2 year, and they both started to decline before the Fed started moving rates lower. Now what we're looking at is the opposite. We're looking at both of them breaking higher before the Fed even starts to raise interest rates. What I think is really interesting, the 2 year has broken higher, but the 1 month has not. So here on the back end, you see the 2 year, of course, all the way up here to 1.6. I think that's a little stretched because that would basically say, look, at a quarter basis point move, you're talking about 6 rate hikes. I don't think the economy in its current state, if we are tightening into this slowdown, I don't know that the economy can handle 6 rate hikes. If you haven't seen our conversation with Dan, I'm going to show you Dan being Dan Thornton from D.L. Thornton Economics, a previous Fed official at the Federal Reserve St. Louis Bank. I'm going to pull up his interest payments. So here is interest as a percent of GDP in the 10-year Treasury rate. So the 10-year Treasury, of course, at the time that he did this, ended in 2020. But as the 10-year rises, you're going to see a rise in the interest payments on the debt. And we know the debt's now roughly $30 trillion, given the fact that we've had to bring on more and more post the pandemic, right? So his argument is, look, higher interest rates or higher debt is not an issue as long as you have a situation where the 10-year remains relatively low, because it's servicing the debt that matters. So a rising interest rate leads to a rising servicing cost of the debt, which is rising interest rate payments, which then can take away from other government programs like Social Security, Medicare, military spending, so forth and so on. And so that's where it creates an issue and where you could get an investor sentiment change, be it overseas investors, since they hold a large amount. I'm going to show you this here. Since they have a large amount of debt being held by the foreigners versus being held publicly or being held by the Federal Reserve. So these shifts and moves, is where I think the market's having its anxiety, is because, look, if interest rates get too high too quick, we brought on a lot of extra debt throughout the pandemic. We didn't retire a lot of debt in the last expansion, and so debt servicing is going to create such a burden, and that could certainly start to weigh on on investors. I think you can also see it a little bit better in the high yield option adjusted spread as that starts to lift off here. That's usually a good sign of some cracking here. Normally, that gets into the 4s and 5s before a signal is really dire. We're at 3.5 right now, so we're not quite there. You can see that back in 2020, it got roughly above 4 before something happened. So again, I think you're getting this flavor of why it's so important that we remain defensive, despite kind of this offset move of the buyers that kind of came in. When we flip over to the Z-scores, I think you're going to see it here as well. So again, the Z-scores are just looking at it, for those that are new, looking at it from a standard deviation perspective. So how far are these moves away in one standard deviation or two standard deviations on the upside, or one or two on the downside. So you did get a pretty sharp move as we saw a lot of dip buying, but you're seeing this kind of return back down to the lower levels as everybody started to reprice more interest rate hikes. So I think you need to stay diligent out there. With this move in the 10-year and the 2-year, I think it makes sense to consider, looking back at the fixed income side of your portfolio. Again, coming in here, you're seeing long-dated Treasury sell off and hit one standard deviation below their mean. Again, TLT, one standard deviation below. I skipped tips, but tips are really interesting considering inflation is still accelerating, and they're all the way down here at a half a standard deviation below their mean. That's about where they've been before really starting to move. We don't really start to create some problems here with, again, the coronavirus response as it got down to almost 2 standard deviations below its mean. But certainly looking at those, this is, I think, really, really interesting. We saw mortgage-backed securities break through this 0.5%. We didn't see that until this moment here in the COVID crisis. So it had been holding pretty steady between these two bands here, and it has finally broke. So this could be another key measure of risk starting to build as, again, we're trying to all reprice some new information here. So, I think this is a good place for us to stop. I think you're getting a flavor of how the market is pricing and reacting to this information. One of the things that I heard and read as we were doing research yesterday, and it was going all over Twitter, was that there might be an emergency hike. Again, going back to that chart where the 2-year is so far ahead of the Fed. I'm not sure. With the 1-month rate staying within that targeted range without seeing an initial spike or any pressure on the 1 month, I don't really see that. There's not really a ton of pressure going on the 3-month minus the Fed. It is spiking a little bit here. And so they'll try to bring that down some, but I don't know that there is necessarily going to be an emergency move. But what I do think this CPI report has done is woken the market up to the fact that tapering is inevitable. I said it in a tweet after Jerome Powell, his last press conference. He said specifically that, look, we're now moving into a period where we're going to tighten monetary policy. Like, point blank, he didn't mince words about it. It's why the market kind of was happy around the original statement when it was released, but started to sell the market after he started to, give his comments and take questions. So, we're still, again, very much in that defensive camp. And I think, again, we could remain here for at least the first quarter and potentially the second quarter, depending on how inflation drags on economic growth, because that's the change in behavior, right? At a certain point, price increases are going to weigh on consumers, and consumers will change their consumption patterns. They may eat more food at home. They may delay travel. They may delay a big purchase as they wait for prices to come down. So again, we'll continue to monitor this. I think the University of Michigan sentiment survey will be really interesting to see. Of course, it's going to be from January, so it may not quite have the full 7.5% coming in, as the media is now kind of pushing that out in general. But I do think that, again, you're continuing to see a flavor of what we've been talking about over our daily notes, that risk is rising, that to tackle inflation, the Fed has to slam the brakes on the economy. And I think that's what's going to cause a little bit of a hiccup as everybody tries to readjust their portfolios and reprice that risk in here. So again, if you guys have any questions, please reach out. We're always happy to help. And we will be back again on Monday with an update and a follow-up on the Michigan Sentiment Survey.